There is one sentence that has been repeated so many times in American culture that most people have accepted it as financial gospel without ever stopping to question whether it is actually true. Renting is throwing your money away. You have heard it from your parents. You have heard it from your real estate agent. You have probably said it yourself at some point. And today I am going to tell you something that the real estate industry has spent decades trying to prevent you from understanding clearly. That sentence is not entirely true. And depending on where you live, how long you plan to stay, and what you do with the money you save by renting, it could be the most expensive financial myth you ever believed. Now, before the homeowners in the comments come for me, let me be clear about something. I am not saying buying a home is bad. I am saying the decision is far more nuanced than most people are ever told, and that nuance is worth millions of dollars over a lifetime if you get it right. Drop a comment right now. Are you currently renting or do you own your home? And if you are renting, do you feel like you are falling behind financially because of it? I check every comment on this channel. Welcome back to Rich Habits. Subscribe if you are new here because this is the video that will finally give you a clear, honest, data-driven answer to one of the most consequential financial decisions most Americans ever make. Let us start by destroying the myth, because it needs to go. Renting is not throwing money away. That framing only works if you define throwing money away as paying for something you do not permanently own. But by that definition, every car insurance payment is thrown away. Every grocery bill is thrown away. Every electricity payment, every medical bill, every restaurant meal. You are paying for shelter, which is a genuine necessity, and receiving shelter in return. The transaction is complete. Nothing was thrown away. The real question, which nobody phrases this way, is not whether renting is wasteful. The real question is whether the money you do not spend on a down payment, mortgage interest, property taxes, insurance, and maintenance could grow faster somewhere else. And the honest answer to that question in 2026 is sometimes yes, sometimes no, and it depends almost entirely on three things. Those three things are how long you plan to stay, where you live, and whether you actually invest the money you save by renting rather than spending it. Everything else is noise. Here is what the data says about the current landscape, because these numbers matter and most people do not know them. On a purely monthly cost basis, renting is cheaper right now in most of the United States. The all-in monthly cost of homeownership on a median-priced American home, including mortgage, property taxes, insurance, and maintenance, typically runs $3,000 or more per month. The national median rent for a two-bedroom home is around $1,450. That is a monthly gap of over $1,500 in many markets. Now that gap is not free money for renters. A homeowner is building equity with every mortgage payment while a renter is not. But that gap represents capital that a disciplined renter could invest in the stock market, in dividend stocks, in index funds, anywhere that compounds over time. The question is whether renters actually do that. And behavioral research consistently shows that most do not. Most renters spend the difference, which is precisely why homeownership tends to produce better financial outcomes for the average person, not because it is mathematically superior in every case, but because it functions as forced savings that most people would never impose on themselves voluntarily. Here is the specific framework you need to make this decision correctly for your own situation, and I want you to write this down because it will save you from making a decision worth hundreds of thousands of dollars based on emotion rather than math. The first thing to know is the 5 to 7 year rule. In most United States markets in 2026, buying a home only makes financial sense if you are confident you are staying for at least 5 to 7 years. The reason is closing costs. When you buy a home, you typically pay between 2 and 5% of the purchase price in closing costs up front. On a $400,000 home, that is $8,000 to $20,000 spent before you make a single mortgage payment. It takes years of equity building and appreciation to recover those costs. If you move in 3 years, you almost certainly lose money compared to a renter who invested the equivalent amount. The second thing to know is the price-to-rent ratio in your specific city. This is calculated by dividing the purchase price of a home by its annual rental equivalent. A ratio above 20 typically favors renting. A ratio below 15 typically favors buying. Most major United States markets currently sit between 18 and 25, meaning the decision is genuinely close in many places. But coastal cities like San Jose, San Francisco, and New York often sit at 30 or higher, meaning the math strongly favors renting and investing the difference in those specific markets. Midwest cities like Chicago, Cleveland, and Indianapolis often sit below 15, meaning buying is clearly the better financial move there. The third thing to know is perhaps the most important, and it is the one almost nobody mentions. A 2026 analysis found that the forced savings of a mortgage drives a 43-to-1 wealth gap between homeowners and renters over time. That number sounds enormous until you understand why it exists. It is not because homeownership is 43 times more financially efficient than renting. It is because most renters fail to actually invest their monthly savings into the market. They spend it. And a homeowner who has no choice but to build equity through mortgage payments is, in practice, saving more effectively than a renter who has the freedom to invest but chooses not to. If you are a renter who actually invests consistently, that 43-to-1 ratio compresses dramatically. If you are a renter who spends the difference every month, homeownership is almost certainly the better wealth building path for you, not because the math is better but because the behavioral structure is. Now let us talk about what buying actually does for your wealth, because the equity story is real and significant. When you own a home, every mortgage payment you make consists of 2 components. One portion goes toward the interest on your loan, which functions similarly to rent in that it does not build ownership. The other portion goes toward the principal, reducing what you owe and increasing your ownership stake. In the early years of a 30-year mortgage, most of each payment is interest. In the later years, most of it is principal. This is why staying in a home long-term accelerates equity building dramatically. In 2026, owning a typical single-family home now costs less than renting a 3-bedroom property in 57.7% of the 364 counties analyzed by the ATTOM 2026 Rental Affordability Report. That is a significant shift from previous years, and it reflects a market where rents have continued rising in many regions while home price growth has moderated. There are also tax advantages to homeownership that most renters never account for in their calculations. Mortgage interest is deductible, property tax payments can reduce your taxable income, and when you eventually sell your primary residence, the first $250,000 of profit is tax-free for a single filer and $500,000 for a married couple. These are genuine financial advantages that a renter investing in the stock market does not receive. The appreciation story is also powerful over long timelines. The average American home has appreciated at approximately 3 to 4% annually over the last 50 years. On a $400,000 home, 4% annual appreciation means $16,000 of value added per year simply from market forces, without you doing anything at all. Over 20 years, that same home could be worth close to $900,000, meaning you built nearly $500,000 in wealth purely through appreciation while living in the asset. But here is where I want to give the honest case for renting that most financial content ignores, because it deserves to be heard clearly. For a disciplined investor living in a high price-to-rent ratio city who genuinely invests the monthly difference between what they would spend on a mortgage and what they spend on rent, the math can favor renting over a long period. If you rent for $2,000 a month in a city where the equivalent mortgage would cost $4,000, and you consistently invest that $2,000 monthly difference in an S&P 500 index fund returning 10% annually, over 30 years you would accumulate approximately $4.5 million from those investments alone. That is a competitive outcome with homeownership in most markets. The catch, as always, is the word consistently. Behavioral research suggests that most people do not actually invest the difference. They upgrade their lifestyle with it. They spend it on things they wanted but previously could not afford. And that spending is the reason homeownership wins the wealth race for the average American in practice, even when renting might win it in theory. There is also the psychological value of ownership that does not appear in any spreadsheet. The stability of knowing your housing costs are fixed for 30 years while your renting neighbors face annual increases. The ability to renovate and build the home you want. The pride of ownership that for many people translates into better maintenance, longer tenure, and ultimately more wealth accumulation. These things are real and they matter even if they are difficult to quantify. So where does this leave you in 2026 specifically, with mortgage rates sitting between 6 and 7% and home prices still elevated from the post-pandemic surge? If you are planning to stay somewhere for at least 7 years, your local price-to-rent ratio is below 20, and you have a solid down payment saved without depleting your emergency fund, buying almost certainly makes more financial sense over your holding period and you should pursue it. If you are planning to move within 5 years, your local price-to-rent ratio is above 25, or your down payment would leave you financially stretched and without a cushion. Renting while investing the difference aggressively is the smarter move and you should not feel any shame about that choice. And if you are in the middle, which is where most Americans actually find themselves in 2026, the right answer is to run the numbers for your specific city, your specific timeline, and your specific financial situation rather than accepting a generalization that was probably shaped more by cultural mythology than financial analysis. The 5% rule is a quick way to test your situation right now. Multiply the purchase price of any home you are considering by 5%. That is the annual break-even rent. If you can rent a comparable home for less than that annual figure, renting is likely the better financial decision. If comparable rent exceeds that figure, buying begins to make more sense. On a $400,000 home, 5% is $20,000 annually, or $1,667 a month. If you can rent something comparable for significantly less than that, your capital likely works harder invested elsewhere. Now before you go, I have 2 questions for the comments and I genuinely want to see both answers. First, are you currently renting or buying, and are you happy with that decision financially? Second, if you are renting right now, are you actually investing the money you save compared to what a mortgage would cost, or are you spending it? Be completely honest. I check every comment on this channel and this conversation is exactly what this community needs to have. If this video gave you a clearer picture of one of the most important financial decisions of your life, please give it a thumbs up and share it with someone who is trying to figure out whether to rent or buy right now. Subscribe to Rich Habits so you never miss a video. I will see you in the next one.